Markets just repriced risk. Not because of a boring earnings report, not because of rates, because the world's energy backbone just got shook. Prices broke above $80 a barrel today. And that alone tells us risk has fundamentally shifted. By the end of this video, you'll understand why one number, oil's surge, changed how global markets are pricing risk right now, and what that means for stocks, bonds, commodities, and your portfolio. Most people will glance at that oil spike and treat it like background noise, another geopolitical headline in a long stream of global tension. But markets don't move this decisively in a foundational commodity unless something deeper has shifted beneath the surface. When oil pushes above $80 in response to escalation involving Iran and renewed concerns around the Strait of Hormuz, a narrow corridor responsible for roughly 20% of globally traded oil, what you are actually watching is not panic, but recalibration. Capital is quietly reassessing probabilities, because markets are not pricing what has already happened. They are pricing what might happen next. And when the probability of disruption increases even slightly, the required return on risk assets increases with it. That is what repricing means in its simplest form. It means the discount rate applied to future earnings just ticked higher, because the world looks marginally less predictable than it did yesterday. Oil sits at the center of that adjustment, because energy is embedded in everything. Transportation, logistics, agriculture, aviation, manufacturing, consumer goods. The cost of energy flows into the cost structure of the global economy. When oil rises sharply on geopolitical tension, investors immediately begin asking second-order questions. If energy costs remain elevated, do corporate margins compress? If margins compress, do earnings expectations soften? If inflation expectations edge higher again because of energy, does that complicate central bank positioning? And if policy becomes more cautious or restrictive, do equity multiples deserve to stay where they were? Notice how one commodity price can ripple outward into bonds, currencies, equities, and sentiment almost instantly. That is the web you are investing inside. And what is interesting about the reaction so far is that it has been selective rather than chaotic. Energy producers have strengthened. Defensive sectors have shown relative resilience. Gold has attracted safe haven flows. Meanwhile, high beta growth stocks and more cyclical names have felt pressure. That pattern tells you this is not indiscriminate fear. It is structured repositioning. Institutions are not slamming the sell button on everything. They are adjusting exposure where uncertainty matters most and leaning into areas that may benefit from higher energy prices. This is the difference between a headline event and a regime adjustment. A headline fades. A regime adjustment alters how risk is calculated across the system. When escalation introduces the possibility, not certainty, but possibility, of sustained disruption through a choke point like Hormuz, traders widen their range of expected outcomes. And when outcome ranges widen, risk premiums expand. Oil breaking above $80 is simply the most visible expression of that expansion. It is the market saying the distribution of future scenarios just widened and compensation for uncertainty needs to increase. To understand why that matters, you have to zoom out beyond today's candle. For months, markets have been anchored to a relatively stable macro narrative. Inflation cooling. Central banks gradually regaining flexibility. Earnings holding up better than feared. Risk assets trading on the assumption that major systemic shocks were not imminent. When oil spikes abruptly on geopolitical tension, that stability assumption gets challenged. Energy is one of the few inputs that can reawaken inflation concerns quickly. Even if the direct impact is temporary, higher fuel costs filter into transportation, food distribution, airline pricing, and shipping insurance. Businesses may hedge, but consumers ultimately feel higher energy costs. That creates a psychological shift as much as a mathematical one. Inflation expectations are partly about perception, and perception can move faster than official data. Bond markets begin to consider whether higher oil could complicate rate cut expectations. Equity markets consider whether margin pressure could creep into future quarters. Currency markets reassess which economies are net beneficiaries or victims of higher commodity prices. Emerging markets that rely heavily on energy imports may feel pressure. Exporters may find relative support. This is how a single geopolitical variable transmits through the financial system. But here's the part that often gets missed. Repricing does not equal collapse. It equals adjustment. Markets continuously update their model of the world. They do not wait for certainty. They update probabilities in real time. Oil's surge tells us the market believes the risk of supply disruption has increased from low to meaningful. Not guaranteed, not catastrophic. Meaningful. That subtle distinction matters because it prevents overreaction. If the market were pricing guaranteed supply loss, oil would be significantly higher. What we are witnessing instead is the addition of a geopolitical risk premium layered onto existing valuations. That premium can expand if tensions escalate further. It can contract if diplomatic pathways reduce perceived threat. But in either case, the mechanism remains the same. Higher perceived risk demands higher expected return. Higher expected return lowers the price investors are willing to pay today. That is why stocks soften when uncertainty rises, not because the economy vanished overnight, but because future cash flows are discounted at a slightly higher rate. From a portfolio perspective, this is where maturity matters. The temptation is to interpret volatility as chaos. But volatility is information. It reveals which assets are sensitive to which risks. It reveals where leverage exists in the system. It reveals how quickly capital rotates when narrative shifts. Energy equities rising alongside oil tells you those businesses have operating leverage to commodity prices. Defensive sectors holding up tells you investors value stable cash flows in uncertain environments. Gold attracting bids tells you psychological hedges regain appeal when geopolitical friction rises. Growth stocks wobbling tells you long-duration cash flows are sensitive to changes in discount rates. This is not random movement. It is capital expressing preference under uncertainty. And this is where your identity as an investor becomes important. Are you someone who reacts to surface volatility or someone who interprets structural shifts? Because understanding the mechanism behind repricing changes how you behave. Instead of asking whether to sell everything, you begin asking whether your portfolio assumes a world of perfect stability. You ask whether you are overexposed to sectors vulnerable to input cost spikes. You ask whether you have liquidity to deploy if volatility overshoots fundamentals. Oil above $80 is not unprecedented. Historically, oil has traded far higher. But context defines impact. The current macro backdrop includes inflation sensitivity, central banks still cautious about declaring victory, and equity valuations that have been supported by relative stability. In that environment, a sudden energy spike has more narrative weight than it would during a period of already elevated commodity volatility. And narrative weight matters because markets are not purely mathematical systems. They are psychological systems layered on top of mathematics. The story investors tell themselves about the world influences how aggressively they price risk. If the story shifts from stable disinflation to fragile geopolitical tension, capital behaves differently. The deeper lesson here is about fragility and resilience. Fragility is being positioned in a way that assumes smooth outcomes. Resilience is being positioned in a way that absorbs shocks without forcing reactive decisions. Repricing events expose fragility. They also reward resilience. If escalation continues and oil sustains higher levels, inflation expectations may firm. If inflation expectations firm, central banks may signal caution. If policy remains tighter for longer, equity multiples may face incremental pressure. That is the chain reaction investors are mentally mapping right now. Not because it is certain, but because it is plausible. And markets price plausible futures, not just confirmed ones. On the other hand, if tensions cool and supply fears ease, some of this risk premium could unwind. Oil could retrace part of its surge. Equities could stabilize. Gold could give back gains. That too would be rational. Because repricing works both ways. What remains constant is the mechanism. The world shifts. Probabilities adjust. Capital reallocates. When you view markets through that lens, today's oil spike becomes less dramatic and more instructive. It is a reminder that global finance is interconnected. A narrow shipping corridor thousands of miles away can influence the valuation of assets in your brokerage account within hours. Insurance premiums, tanker routes, commodity futures, inflation expectations, central bank policy, equity multiples. It is all connected, and when a central node in that network tightens, the system recalibrates. The mistake most investors make in moments like this is either complacency or panic. Complacency ignores the signal. Panic exaggerates it. The disciplined response is observation. Observe how capital moves. Observe which sectors display strength. Observe how bond yields react relative to inflation expectations. Observe currency movements in energy importing versus exporting economies. These observations give you insight into positioning, into sentiment, into fragility. They help you understand not just what moved, but why it moved, because ultimately, markets just repriced risk. And that repricing was triggered by one visible catalyst: oil breaking above $80 amid geopolitical escalation. But the real story is larger. It is about how quickly the financial system adapts to shifting probabilities. It is about how energy, inflation, policy, and valuation intertwine. It is about recognizing that stability is often assumed until it is questioned. And when it is questioned, even slightly, prices adjust. Your advantage as a long-term investor is not predicting the next headline. It is maintaining perspective while headlines unfold. It is constructing portfolios that do not require perfect geopolitical calm to succeed. It is understanding that risk expands and contracts, but disciplined strategy remains constant. Oil's surge is a signal, not of doom, not of certainty, but of increased sensitivity within the system. And when you understand that sensitivity, you stop reacting emotionally and start responding strategically. That is what just happened. The world looked marginally less predictable this morning than it did yesterday. Markets noticed, capital adjusted, risk premiums widened. And now you understand why that one number, oil's surge, quietly reshaped how global markets are pricing risk across stocks, bonds, commodities, and your portfolio. And there is one more layer most investors never think about, which is that repricing events often reveal how stretched positioning already was before the catalyst hit. When a system reacts quickly to a new variable, it sometimes means valuations were leaning heavily on stability assumptions that had not been seriously challenged for a while. In calm periods, investors compress risk premiums because confidence grows in smooth macro outcomes. When disruption appears, even modestly, those compressed premiums have to expand again. That expansion can feel dramatic, not because the shock is unprecedented, but because complacency had quietly built up. Oil's surge is therefore not just about supply routes or military escalation. It is about the fragility of expectations. It is about how quickly confidence can shift from comfortable to cautious. And in that shift lies both danger and opportunity. Because when risk premiums expand, future expected returns also expand for disciplined capital willing to endure volatility. That is the paradox. The same event that unsettles short-term sentiment can improve long-term opportunity sets. Provided you are positioned with patience rather than leverage, clarity rather than fear, and structure rather than impulse.